Welcome back to the EcoVantage report. We were promised a soft landing. For the last 2 years, central banks and financial markets have repeated the same message. Inflation was under control, the economy was stabilizing, and the worst was behind us. But reality is telling a different story. Recent inflation data has shown prices rising faster than many economists expected, raising concerns that inflationary pressures remain far from defeated. This isn't simply about one economic report. It's about a deeper shift taking place beneath the surface of the global economy. While Wall Street remains focused on the technology boom and record-breaking AI investments, everyday affordability has become one of the defining issues of our time. And to understand why, we need to stop looking at spreadsheets and start looking at the global map. Inflation today is no longer driven solely by monetary policy. It is increasingly shaped by geopolitics. For decades, globalization helped keep prices low. Companies built supply chains that stretched across continents, producing goods wherever costs were cheapest. That era is ending. Governments are imposing tariffs, export controls, sanctions, and investment restrictions at levels not seen in decades. Companies are no longer optimizing for efficiency. They are optimizing for security. Factories are being relocated. Supply chains are being duplicated. Critical industries are being brought closer to home. While this may improve resilience, it also means higher costs. The age of the cheapest possible production is giving way to the age of strategic production. And then there is the tariff effect. Across the world, governments are increasingly using trade policy as a geopolitical weapon. What was once a global marketplace is becoming a collection of competing economic blocks. The result is simple. When countries prioritize security over efficiency, costs rise. Consumers ultimately pay the price. At the same time, ongoing geopolitical tensions continue to threaten energy markets and global transportation networks. Every disruption creates new costs. Every uncertainty increases prices. And eventually, those costs make their way to ordinary households. This leaves central banks facing a difficult challenge. Markets spent months expecting aggressive interest rate cuts. But if inflation remains stubbornly high and labor markets remain resilient, policymakers may have less room to ease financial conditions than investors previously expected. The US dollar has strengthened significantly. While that may appear positive on the surface, a stronger dollar can create enormous pressure across the global economy by making imports and debt repayments more expensive for many countries. And yet, despite these pressures, stock markets continue to be powered by one dominant narrative: artificial intelligence. The market is betting that AI will drive a new era of economic growth. But there is one reality investors often overlook. AI is not purely digital. It depends on physical infrastructure, massive data centers, power grids, transmission lines, transformers, copper, steel, water. The challenge is not simply producing more chips. Utilities across the world are struggling to secure the equipment and raw materials needed to expand electrical infrastructure fast enough to meet growing demand. The future may be digital, but building that future requires enormous amounts of physical resources, and that creates inflationary pressure of its own. History offers an important warning. During the 1970s, inflation was repeatedly declared defeated, only to return stronger after each temporary decline. Policymakers underestimated how deeply embedded inflation had become within the economy. What followed was a painful period of high interest rates, economic slowdown, and financial stress before inflation was finally brought under control. Today's economy is very different from the 1970s, but the lesson remains the same. Inflation can be far more persistent than markets expect, and once structural forces take hold, they become extremely difficult to reverse. Smart investors are paying close attention. Many are increasingly focusing on sectors tied to physical infrastructure, energy systems, industrial capacity, and critical resources. Because in a world defined by supply constraints, those assets become increasingly valuable. The inflation we are experiencing may not be a temporary disruption. It may be part of a larger structural reset driven by geopolitics, resource competition, and the growing demand. The narrative of the soft landing is beginning to crack. The real question is what comes next. If you want to understand the forces shaping the future of economics, energy, technology, and global power, subscribe to the EcoVantage report. Stay ahead, and we'll see you in the next deep dive.